Good morning, everyone, and welcome to the JRG Advisor special webinar on the IRS guidance for assessment of employer shared responsibility payments. I'm Frances Horn, and I am the Employee Benefits Compliance Officer for JRG Advisors. A little bit of housekeeping before we start into the presentation. We will be sending everyone who is on the webinar today a copy of the presentation and a recording of the presentation in an email in a couple of days. And also, if there are any questions that are asked, we will send you a copy of the Q&A. So as a reminder with the Q&A, if you have any questions, you can go ahead and type that question in the question box and then send it over to us. Also, for those of you who would need human resource certification credits, this is the the webinar is eligible for 1 credit, and we will send that certificate if you let us know that you would need that. We do have to make sure that you are on the webinar for the entire hour in order for you to get the credit. So with that being said, let's go ahead and get started. We have a short agenda here, and I think the first thing we have on the agenda is why are we discussing this? Where is this coming from? What's happening? So we are going to do a short overview, again, of the requirements under the Affordable Care Act as to offering coverage for, certain employers who are usually considered large employers. We're going to talk about this notice that the IRS has put out, how you respond to if you do receive a letter or notice, some transition relief that you may want to look at. Do I really have to comply with this? Some tips and then some questions. So with that being said, let's start with our overview. We're going to be talking again about the employer mandate and these reporting requirements we have. A little bit of background, we know that the ACA really represented the most significant overhaul to our healthcare system since 1965 when Medicare was passed. And the ACA was enacted for the purpose of increasing quality and affordability of healthcare, expanding public and private insurance coverage, and reducing healthcare costs for individuals. And what the ACA did was, it provides for various mechanisms in order to meet those goals. And the first mechanism that we're not going to go into detail, we're just mentioning here, is that individual mandate. Under the individual mandate, it says that every citizen of the United States will be covered with what's called minimum essential coverage. You have to have health coverage, or you would pay a penalty. And in order to help coverage to be affordable, the Act went ahead and initiated what's called a premium assistance. So certain individuals, when meeting certain requirements, they were available to get coverage on the exchange, and they would also be eligible for a subsidy. And then finally, the last mechanism by the ACA put in place is what's called the employer mandate. And it's really expected that employers provide health care to their full-time employees and really not direct them to go onto the exchange. So the ACA really penalizes employers of a certain size who did provide coverage or coverage that is not minimum essential coverage, minimum value, or affordable. Now we know that the IRS, the Internal Revenue Service, is the agency for enforcing these provisions, and we're going to see actually how they are going about that enforcement in a couple of slides. So we've already mentioned the different mechanisms, and we mentioned about the employer mandate. So under the Affordable Care Act, it's also known as the Employer Shared Responsibility Provision. Certain employers called applicable large employers, or ALEs, must offer health care coverage to their full-time employees and dependents. Now, I just want to digress for 1 second. We refer to this as the employer mandate. Some people have called it the pay or play mandate. Again, employer shared responsibility. And also, some people will reference it to the section of the Internal Revenue Code that it falls under. And it comes under Internal Revenue Code section 4980H. And we're going to talk about the penalties because there's something called an A penalty and a B penalty. And this A penalty is what we're talking about now. So when we talk about this ALE, or applicable large employer, that's an employer who employed on average 50 full-time or full-time equivalent employees in the preceding calendar year. So going back to 2015, if you measured as an ALE in 2014, then in 2015, you were required to offer minimum essential coverage, again, known as MEC, to your full-time employees and dependents. Now, our second bullet here talks about, it says 70% and then 95%. So you're probably saying, okay, which is it? Well, the general rule under the statute says that an employer has to offer this MEC coverage to at least 95% of its full-time employees. However, and we're going to talk about this transition relief in a couple more slides, the Department of Labor and the IRS came out and said, we're going to give employers a little bit of break because you're still trying to acclimate yourself to this new law here. So they said for 2015, you only had to offer the coverage to 70% of your full-time employees. So that's the first thing that you want to go ahead and note. So when could this penalty be assessed? So either if you did not offer the coverage at all to your employees, and at least one full-time employee received a premium tax credit for having exchange coverage. In that situation, under this A penalty, if those two conditions were met, then you as an employer, you had the potential to make an employer shared responsibility payment for every full-time employee that you have. And the penalty amount, it is increasing. First of all, it is determined on a monthly basis because maybe for a couple months you didn't offer coverage and then you decided to offer coverage. So it doesn't automatically mean you're assessed a penalty for an entire year. So the IRS does look at you on a monthly basis. And again, this penalty would be assessed every full-time employee if you did not offer MEC to at least 70% of your full-time employees in 2015. And that penalty was $2,080 annualized, and that comes to $173.33 a month. Now, I just want to go ahead and remind you, this responsibility, this mandate is still out there, and each year the penalty is increasing. And as the slide shows, it went up to $21.60 in 2016 and $22.60 in 2017. Another point that we want to go ahead and mention. When we say that you have to offer coverage to your full-time employees and dependents, a dependent does not include the spouse. It only includes the children. And it only includes the natural children or adopted children of the employee. It does not include stepchildren or foster children. So the next part of this employer mandate, or under Internal Revenue Code Section 4980H, we're going to what's called the B penalty. And again, this is specifically a second penalty that was introduced by the ACA and that an ALE is subject to. So if as an ALE, you've been a good citizen and you've offered that minimum essential coverage to your full-time employees and dependents, but that coverage either isn't considered minimum value or it's not affordable for the employee, then you as an employer can be subject, again, to the employer shared responsibility payment if at least one employee, again, receives a premium tax credit on the exchange. So again, conditions have to be met. Coverage was not minimum value or not affordable, and at least one full-time employee receives that premium tax credit. Now, the key difference here between the A penalty and the B penalty is, again, the A penalty is assessed against every full-time employee. The B penalty is only assessed against each full-time employee who receives a subsidy. So if you only have one full-time employee receive a subsidy, then you could only be subject to one penalty. And just like the A penalty, the penalties have increased over the year. Starting in 2015, it was $3,000 annualized, or $250 per month. Went up to $3,240 or $270 per month, and then in 2017, the penalty is $3,390 or $282.50 a month. Just as a quick review, minimum value it means that you're offering what's considered at least a bronze plan. And affordable means that for 2015, that the coverage could not exceed 9.56% of the employee's income for the year. So what they had to pay for coverage, again, couldn't exceed 9.56%. And again, we see how that number has jumped around a little bit for 2016 and 17. So this slide here, this is really something that you can just go ahead and print off and keep for your reference. It's just a summary of these A and B penalties, about the conditions that have to be met, who it's applicable to, and what the penalty could, and how the penalty could be assessed, or what penalty can be assessed. So the as we already stated, the Internal Revenue Service, or IRS, was charged with the oversight responsibility of ensuring that you as an ALE comply with the employer mandate. Now, what the IRS did was really amend the Internal Revenue Code by including an employer responsibility reporting requirement. So what you as a full-time, as an ALE, you had to provide a report known as a Form 1095C to your full-time employees, and you also had to report this information on a Form 1094C to the IRS. That 1094C is a transmittal form. So this is how the IRS had the oversight. They had the employer basically self-report. Yes, we offered coverage, or no, we didn't offer coverage to our full-time employees. This is the kind of coverage it was. It was minimum value, or it wasn't minimum value. It was or was not affordable. We offered it to the spouse. We offered it to the dependent. So you're reporting actually what kind of coverage you offered, or what kind of coverage the employee had. Now, there's a lot more nuances to this reporting, but again, the purpose of this presentation isn't to go into the reporting requirements. So this is just a short reminder for you. So now we're going to go ahead and move into, again, this notice of potential liability you could be receiving, which is known as the letter 226J, and we're also going to talk about your response. So ever since the enactment of the Affordable Care Act and the requirement for ALEs to offer coverage, it was not really made clear how these requirements would be enforced. We just kept telling you as employers, you need to do it, you need to do it. Well, now, again, the IRS, they were pretty vague, and in its question and answers, it merely said that the IRS expects to publish guidance. Well, as of November 2nd of this year, this vagueness or ambiguity, it's really been removed, because the IRS did issue a Q&A on November 2nd, and the IRS clearly provides the general procedures it will use to propose and assess the employer shared responsibility payment. So the IRS plans to issue letters to employers who owe a payment, or who they believe owe a payment. That letter is called the 226J, and it will be issued if the IRS determines that for at least 1 month in the year, one or more of the ALE's full-time employees received a premium tax credit. So the IRS indicated it's going to start this assessment and collection process in late 2017. Well, here we are, the last day of November. We have 30 days to be in the late 2017. And I haven't heard, or I haven't seen, but maybe some employers have received this letter. Now, when you receive a letter, the IRS is starting to review the 2015 tax year. It may also include 2016, but definitely not 2017 yet, because again, the year isn't over. So this letter 226J, I mean, what really can you expect from it? It is going to be your first or your initial letter that's going to be issued to you as an ALE to notify you that you may be liable for this employer mandate responsibility or the payment. The determination of whether an ALE is liable for a payment and the amount of the payment is based on information from the forms 1095-C that you gave your employees, the 1094-C that you reported to the IRS, and the individual income tax return filed by your employees. What the letter will contain is it's going to have an explanation of Internal Revenue Code 4980H. It's going to talk about that A penalty and the B penalty that we just discussed, and it may go into a little bit further detail. The next item it will include is a summary table showing the proposed penalty on a monthly basis and whether the penalty is assessed based on the violation under 4980HA or 4980HB. So it's going to say you either didn't offer next coverage or you didn't offer coverage that was affordable or minimum value. The letter is also going to include a copy of a form 14764. And this is the form that you will respond to the IRS on. And we'll look at these forms in a couple of slides, so don't get too much into a panic mode yet. And then also it's going to have what's called a PTC list, a premium tax credit list. This is a list that has, on a month-by-month basis, your accessible full-time employees who, again, for at least 1 month in the year were full-time and they were provided a premium tax credit, and there was no relief available to you as an ALE. The letter is also going to tell you how to respond if you agree or disagree with their assessment, and also the IRS will tell you how it's going to proceed if there is not a timely response. I will repeat this several times in the webinar, only because they have made it clear. If you do not respond to the letter 226J in the time frame that they indicate in the letter, you will be automatically assessed a penalty. Now, again, we've just received this information within the last month, so we have not received any other guidance from the IRS to say, yes, they'll grant an extension or they'll, look at extenuating circumstances. So we're really reading things as the black letter of the information that, or the guidance that we've already received. So this slide talks about that summary table that I just mentioned. And just as another side fact, the letter that you will be getting, 226J, it's actually going to be 7 pages long because, again, it will include the summary table and the other documents. So this is just a shot of the table. And basically what this table is, again, it's outlining on a month-by-month basis. It summarizes your response that you gave to the IRS on your Form 1095-C. So in column A, it says whether you offered MEC, minimum essential coverage, to 70% or 95% of your full-time employees. The next column, it includes the number that you put in there as your full-time employee count. It also will put in there the reduction of employees, which might mitigate your penalty. It includes the count of your accessible full-time employees. Remember, that would be the ones who received that premium tax credit. Tells you under what section the penalty is assessed, and then we'll include the monthly payment, the penalty payment for that month that will be due. So once you get this letter and you see your summary table and it's showing that you owe this penalty, you're going to be able to agree with the letter or disagree with the letter. And the key thing is you need to read the letter and the attachments carefully. Make sure that you understand it. Read it a couple times. I've just looked at samples, and believe me, I read it probably at least 7 or 8 times already. The letter, again, explains the process and how information received affects computation of any penalty. So basically, the IRS is reminding you, hey, we may be penalizing you because what you reported to us. You told us that either the employee wasn't offered this coverage or didn't have the coverage. So upon reviewing the letter and the tables, as an employer, if you agree with the assessment, you will complete the form 14764, you'll sign it and you'll date it, And again, be sure to return it by the due dated, which will be stated in the upper right-hand corner. And if you agree that you owe the penalty, then naturally you're going to go ahead and pay. So you can go ahead and include a check, or if you're set up to pay IRS payments electronically, you can do that. If you do not pay the penalty in full, you will receive a notice and demand letter from the IRS. So what if you're looking at it and you're saying, I know this employee was covered. I've got to look into this a little bit further. So you disagree with their penalty assessment. Again, you are still going to use Form 14764. You're going to complete it, sign it, and date it. And we're going to see when we look at a sample that there is a section where it says, I disagree, and you will check that box. But however, if you're disagreeing, along with the form that they include, you are also going to have to draft a statement with an explanation of your disagreement. You're going to have to maybe say, this employee was offered coverage, and you probably should include the documentation to show that employee had coverage. If you're going to describe any changes, you can, and if you want to make them on, that you may want to make to Form 1095C or 1094C. However, at this point, you do not send the IRS any corrected forms. If you want to make changes to the employee premium tax credit list that you're receiving with the letter, you can actually do that on a Form 14765. It is a PTC listing change form, and you're going to use the indicator codes. And those indicator codes are what we've talked about in the past, and they're from lines 14 and 16 on your Form 1095C. And when you also send back, you may be, again, sending back this revised employee listing. So again, the key thing is do not send back a corrected form. You have to include any information in your statement, and again, make sure that you sign the statement. So once the IRS receives your Form 14764, either saying that you agreed with their penalty assessment or disagreement, they will be communicating back with you. And they'll be communicating back with a version of a letter called a 227. And believe me, I know it's going to be difficult trying to remember all these letters and numbers of these things that you could receive here. However, currently in the IRS's process, they have 5 different versions of this letter 227. And I actually couldn't put my hands on one, but generally the versions will say, we have your information and we agree with you. You don't owe a penalty. So that would be if you're really lucky and you really kept good records. That is a possibility. Or it may say, we've reviewed your information and we still say that you owe a penalty. Or you paid part of your penalty, you still owe this much. So again, there's 5 different variations that you want to be looking out for. And if the letter still says, you know, we looked at your disagreement, but however, we say you still owe the money, then at this point, you may go ahead and request a pre-assessment conference. You may just actually want to say, you know what, I want to talk this through with somebody at the IRS. So you can request that conference with the IRS Office of Appeals. So in the next couple of slides, we're going to be looking at these forms that we've mentioned. So again, this first form is Form 14764, and this is known as the Employer Response Form. So whether you agree or disagree, this will be the form you're sending back to the IRS. So what you will provide is your contact information, the name, the address, a telephone number of you as an employer. And then on the left-hand side, it shows I agree with the proposed assessment, and it will have the dollar amount in there that you're agreeing to. Or you can say, I disagree. Also, if you are making a payment, it will give you a choice of whether you're going to make an electronic payment, whether you're paying in check, or if you're not making a payment. On the second page, which we indicate on the right-hand side of the slide, it's also an optional authorization. So if you're going to be working with an attorney or maybe an accountant who can also communicate with the IRS on your behalf, you would need to go ahead and provide that information. Let them know who that person is. And this is considered limited because it's only going to be as to this assessment and the 1095-Cs. Now, if you want to go ahead and either give someone a power of attorney or work with attorney, there's another process that you have to go through. And you would go ahead and need to check with the IRS as to that process. So that's your Form 147-64. Looks easy, but it is definitely going to be daunting. And then the next form is this 14765. And this is called the Employee Premium Tax Credit Listing, or PTC listing. And this listing will show the name and truncated Social Security number. Truncated means it's only going to have the last 4 digits of an employee's Social Security number on it. And it will have that information for each full-time employee for whom you filed a 1095-C, but their name will be listed on this form only if the employee received a premium tax credit for 1 or more months in 2015, and you as an employer did not report either an affordability safe harbor or other relief for the employee on your 1095-C. Now, each name listing will have 2 rows attached to it. And on the first row, it is going to show, the IRS is going to show what you reported for that employee on your Form 1095-C. The second row of that person's name, if you want to make corrections, that is where you will make the correction. And I have a sample, and we're going to go into that a little bit further. Now, to me, what's a little bit backwards, the IRS makes clear when you receive this form, if the month is highlighted, that is not the month that you owe a penalty for. You would owe a penalty for a month that is not highlighted. So I found that interesting, and I think it's a little bit backwards, but of course I didn't draft the form. So the next slide is again Form 14765, this tax credit listing, and we're going to talk about how you make changes to it. So again, I put my example here. Here I have the employer name. It's ABC Company. I have their ID number, and I've included the tax year, which is extremely important. So again, you probably would be receiving a letter about 2015. So I've inserted 2015. So they're telling us that we owe a penalty for Susie Q. She is our employee name there. And there again, they have her truncated Social Security number. Her last 4 digits are 0001. And it's showing what the employer, ABC Company, reported for Susie Q on the 1095-C. And again, we've highlighted certain months. So for those months, those are not the months that a penalty is being assessed. It is for the month that is not being highlighted. So just to briefly go through this, just as a reminder of information. So in January, we reported for Susie Q a 1H2A. Now remember, I get those codes, or those codes were ascertained from your Form 1095-C on line 14 and line 16. So what we told the IRS with that code is, I did not offer this person any coverage in this month. And 2A says, because this person wasn't an employee of mine. So we put the same code in January and February, and then in March, we changed our code. We changed that to a 1H2D. And what the IRS read from that code is, again, this employer didn't offer coverage to Susie Q in this month, but it was because Susie was in what's called an accessible period. Accessible period. We were looking at her, it might have been her waiting period, excuse me, a non-accessible period. She may have been in her waiting period. She had just started for us, maybe in the middle of March or whatever, and she wasn't eligible for coverage yet. So that's what those codes told us. And then we go down into July, which is highlighted, which means, again, no penalty. And we said 1E and 2C. 1E says we offered Susie and her spouse and dependents coverage, and 2C tells the IRS she was covered. So the month in question that they're saying we're going to owe that penalty for Susie Q is June. And it's because, again, we have it as a 1H2D, saying we didn't offer her coverage because she was still in that waiting period. Well, what the IRS did in this situation is probably said, well, wait a second. The law says an employee cannot have a waiting period of 90 days before you offer them coverage. And what you reported is that she had 4 months or 120 days. So in that 4th month, that's where a penalty is going to kick in because Susie had received a premium tax credit in that month. So when you pull out all of your records and you say, wait a second, Susie Q was covered in June. I just put the wrong code down. So now you're telling the IRS you want to go ahead and make a correction for Susie Q. So my correction would be in the month of June on the 2nd line, and I would use that code 1E. I offered her coverage and she was covered. So that's just an example. Again, we haven't seen anything from the IRS, but based on all the information, what their letter says and what the guidance says, this is something that we would be looking at. Just like the 1095-C, if your change is effective for all 12 months, you would put it in the all 12-month column. Also, you see by the sample here, when you're addressing those codes from line 14 and 16, you separate them with a slash. You still put both codes on one line, you just separate them from the slash. And then finally, if you are going to provide additional information as documentation of what you're saying to the IRS, there is a box at the very end, and you should check it, that says additional information included. So in this example, you may want to go ahead and show, I'm going to go ahead and show my invoice or my insurer that she was covered that month under the plan. That would be additional information. So again, this next slide is really, it's just showing you a summary of the different steps. Once you get the letter 226J, what you should do, the acknowledgement, something that you should go ahead and probably print out and keep for your reference in the next coming months. Again, I've highlighted, put in bold here. If you do not respond to letter 226J or letter 227, the IRS will assess the amount of the proposed employer share responsibility payment. That means you have to make the payment. On this slide, I just wanted to go ahead and give you a little bit more information. If you want to go ahead and pull up the sample letter that the IRS is providing, you can get it at their website at this URL. And also at the next WWIRS website, you can find the employer share responsibility payments. It gives you a little bit more information, what you as an ALE were required to do, what you had to offer. And then also it talks about this the premium tax credit, how an employee may have been eligible. And then finally, if it's unfortunate enough that you do have to pay a penalty and you need to know a little bit more about the IRS collection process, you can find that at publication 594, and that's the URL where you can go ahead and access that. So in our next couple of minutes here, we're going to go ahead and be talking about transition relief and some tips that we want to go ahead and provide you if you do receive one of these letters. So as I already mentioned, we talked about some of the requirements that had to be provided. But back in late 2014 and early 2015, the regulatory agencies, they were providing transition relief really fast and furious, only because they did recognize that there was still so much misunderstanding as to who was an ALE, what type of employer, when did they have to offer coverage, what kind of coverage, that again, they provided what they consider transition relief. So we want to go through some of this. And really, if you're not knowledgeable about this, or if you weren't even aware of this, you may want to look into it, because if you receive a penalty notice, you may have found that you were subject to some transition relief that you didn't apply. So our first transition relief for 2015, general reminder, we know the employer mandate applies to employers who employed at least 50 or more full-time equivalent employees in the previous calendar year. However, for 2015, the IRS and Department of Labor said to us, we're going to give you a little bit of relief again because you haven't had a lot of time to figure this out. So if you were an employer who employed at least 50 employees, but less than 100 full-time or full-time equivalent employees, then for 2015, you did not have to comply with the employer mandate. Now, this between 50 and 100 employees, it was considered that you were what's called a mid-sized large employer. Now, you can't just throw your hands up and say, wow, that's great. You did have to meet certain conditions in order to go ahead and receive this transition relief. And the first condition was that between February 9th, 2014 and December 31st, 2014, you could not have reduced your workforce. In other words, your number of employees, in order to say, I don't have to comply because I don't have these employees. So that means you couldn't have changed your number of employees, or you couldn't have reduced their hours so they weren't full-time employees. Now again, the regulatory agencies aren't so harsh to say, what if you had a good business reason why you had to reduce your workforce? Maybe you lost 2 or 3 contracts that you had, and because you lost those contracts, you didn't need those employees anymore. Or what if you had a division of your company shut down, and so those employees were reduced? Those are all business reasons, and you would need to have documentation of that. We're not looking at that as the criteria. The next criteria or condition is that if you had health coverage as of February 9, 2014, you had to continue it, excuse me, through the end of your 2015 plan year. You also had to maintain the same level of contribution that you as an employer were making, and you also had to make sure that the coverage did provide minimum value. And another condition was that you could not change the eligibility requirements. So that was a mouthful for me. So what does it mean? Maintain your level of contribution. So if you were saying to the employees, employer pays 80%, you pay 20%, you had to maintain that contribution. Now, what if you were saying, well, the employer pays $260 and the employee pays $135? If it was a dollar amount, you could not reduce that dollar amount by more than 5% if you weren't doing a percentage-wise. You couldn't change the eligibility requirements. So if you had said in your plan document that a full-time employee was someone who was considered to work 32 hours and they were eligible for coverage, you couldn't change that and say, oh, no, you have to work 40 hours instead of 32 hours or, 35 hours. So if you made any of those changes, then you lost this transition relief. Now, the key thing to remember is, again, this transition relief said you did not have to offer that coverage. You did not have to comply with the employer mandate. However, as an employer, since you had the 50 employees, you still had to file Form 1095-C for your employees and that 1094-C. And the most important part of the 1094-C was on line 22, you had to check a box that said that you certify that you complied with the 2015 transition relief. So again, that's real important because you're going to have to be able to provide that documentation as your certification. So this transition relief also is applicable to non-calendar plan years for the entire year beginning in 2015. So let's say that your plan year starts in March. So your transition relief would have been available from you from March 2014 up through February of 2015. Another relief that we received in late 2014 was how you determine the size of being an ALE. Generally, we always say you look back at the entire calendar year, the previous calendar year. However, part of this transition relief was that you could only look at 6 consecutive months to see if you were an ALE. So that gave you a little bit of leeway because if you looked at your employee count in 2014 and said, wow, from March, if I looked from March for 6 months, I didn't have 50 employees. But if I look through May for 6 months, I did. You could use the 6 months that was most favorable to you. Again, another nuance that you need to be aware of, and you have to, again, check the rules. So some other relief that was provided by the regulatory agencies. The next one we're going to address was that penalty calculation. So remember we said that for 4980H, you would pay for every full-time employee that you have. And I failed to mention on that first or second slide that as an ALE, you can reduce your penalty by your first 30 full-time employees. However, for 2015, the department said instead of 30 full-time employees, you can reduce your penalty by your first 80 full-time employees. Now again, that's a really big transition relief because if you only have 60 or 70 employees, or even if you have 100 employees and you get to reduce it by 80, that reduces the penalty by multitudes. Now the key thing to remember is that increased reduction was only for 2015. In 2016, the rule goes back to you can reduce your penalty by your first 30 full-time employees. The other transition relief that we had, and we already referenced it on our slide. So the requirement or the statute says that you had to offer coverage, minimum essential coverage, to at least 95% of your full-time employees and dependents. However, for 2015, we know that percentage requirement was reduced to 70% instead of 95%. Again, making it a little bit easier for you to comply. And then finally, we mentioned several times that you also have to offer coverage to dependents. So the transition relief that was received that if you did not offer coverage in 2015 because you never offered coverage for dependents, then you received relief for that year. However, if you did offer dependent coverage, you could not drop it in 2015 and say, oh, guess what, I didn't have to offer to dependents for that year. So I keep mentioning these transition relief rules, they have a lot of twists and turns with them that you really need to know about. So the final transition relief that we're going to look at is what's called the 2015 non-calendar year. And I can remember when this came out, how many times I had to read it over and over and over again, because just the way it was written for one thing, but again, it gets to be really quirky and you need to really understand it. So again, every employer does not provide benefits on a calendar year basis from January to the end of December. Some of you start in March, or some start in May or June or whatever. So there also was transition relief if you had this non-calendar year. And the first requirement is that for your non-calendar plan year, as of December 27th, 2012, and I see a typo there, sorry about that, and the plan year start date could not be moved to later in the year after that date. So that first requirement was that your non-calendar plan year is December 27th, 2012. If you said, we start in March, you could not move that starting of your plan year to June or July or December. You had to always maintain whatever your plan year started at. So if you met that first requirement, there was then 3 different types of relief, where there would be no penalty imposed if you met all the criteria of one of the 3 reliefs. So the first relief was that as the employer, you offered a plan that was not minimum value or affordable for the 2014 and 2015 plan year. You would not be penalized for months in 2015 that are part of the 2014 plan year, as long as it was only applicable, or the penalty would have been applied only to employees who were eligible for the employer's plan as of February 9th, 2014. So what this is saying is, okay, you may have some penalty relief here if you were offering it to employees who are eligible what you had in your plan as of 2014. However, if you brought new employees on, there was no penalty relief available. You could still have been subject to a penalty for that. Again, quirky, nuance, you need to understand that completely. The next relief requirement is that, again, you had a non-calendar plan year and that you covered at least 25% of all your employees as of any date in the 12 months before February 9th, 2014. Remember, I stressed 25% all your employees. And second criteria is that during your last open enrollment before 2014, you offered coverage to at least 33% of all your employees. I think the thing that you have to be recognizing here with these transition relief rules is that you really have to have good documentation, because what the IRS is saying, if you now want to rely on some of this relief, you need to go back 4 or 5 years to see what was happening in your company, and you have to have the records to go ahead and support any of your anything that you're going to ascertain. The final relief for non-calendar plan year is that, again, you had a non-calendar plan year, and that for that year you covered at least 25% of your full-time employees. And during the last open enrollment before the 2014, you offered coverage to at least 33% of the full-time employees. The one transition relief talks about all employees. One transition relief talks about only full-time employees. And the key to remember, when the IRS talks about full-time employees for 2015, they mean an employee who averaged 30 hours per week, not your definition of a full-time employee being 40 or 35 or 32. And the other requirement is then for the plan, your next non-calendar plan year, you did have to offer minimum value coverage, and it had to be affordable to your full-time employees. So again, some transition relief. There's a lot of information on this slide. You need to be aware of it, and you need to understand it. I think also the key thing is the requirement that you could not have moved your plan year to begin at a later date. We know that back in 2015, a lot of the insurers were saying, you can keep your grandfather status or your grandmother status if you go ahead and renew at this time of the year, which may have meant moving the beginning of your plan year. So you have to also look at that information. So with that being said, and all the transition relief being discussed, we're going to go ahead and move on to some tips that you may want to go ahead and look at. So if you receive this letter, 226J, or if you anticipate you're going to receive one, some of your tips would be to review to see if any of the transition relief rules apply to you as offering coverage. And the other thing is, make sure that you have the documentation readily available. If you're saying, I'm going to use the non-calendar year transition relief or the mid-size employer relief, you have to have the documentation to support that. Pull out your 2015 1095Cs that you filed so you can review them and look at them to see. You may catch that you made a mistake. So when you get a letter, you're already prepared saying, yep, I just put down the wrong indicator codes. Also, you should ensure that your measurement and stability periods were appropriately applied on Form 1095C. Remember, as an ALE, you're responsible for tracking your full-time employees. You can either use a monthly measurement period or a look-back measurement period. So you need to have that information. But everything that you reported on that 1095C has to comply with how you said you measure your employees. Review those indicator codes. If you attended our seminar in October that we put on, we gave you a couple of slides that outlined all of the indicator codes for line 14 and line 16 on the Form 1095C. Recognize how those codes correlate. Whenever you're telling the IRS one code, make sure that the second code will not jeopardize you or put you in a penalty situation. So know the codes and know how they correlate. Finally, review that Form 1094C. Look to see who signed it, because the letter 226J will be addressed to the person who signed Form 1094C. Maybe that person has moved on. Maybe they've retired. Maybe they're no longer there. You may want to go ahead and indicate to a person in your mailroom or your receptionist saying, make sure that if anything comes in from the IRS, so-and-so gets it, because we want to make sure that it's going to the right person. So again, that's something internal because, again, you make changes in your company and these types of things happen. The next tip, the things that you want to go ahead and consider, well, we've already said, make sure you respond to the letter. No response results in a demand for payment. Your 227 response that you'll receive from the IRS is, you owe us a payment, please pay us. Organize your response materials. Make a cover letter saying that you're responding to the filing for 2015 based on your letter 226J that you received on such and such a date. Put in a table of contents outlining and explaining the information that you're including, especially if you are including documentation. Say, the table of contents, number 1, I am showing my enrollment forms or my invoices from my insurer showing who was enrolled. Number the pages. I think that's really key. It's so difficult that if you're referencing, page 6, and maybe you have a cover letter that you didn't number, and maybe page 6 is really page 8. You should have them numbered, and then also put tabs. And then finally, follow any IRS instruction. Read what they're telling you in that letter, and then follow those instructions, and I followed them to the T. And then finally, look at your documentation supporting your 1095C reporting. Do you have documentation of your offer of coverage? So did you keep a record of your distribution of who you gave your enrollment materials to? What employees were eligible? You gave them all of their forms. What about the employees who waived? How are you going to show that you offered them coverage? Do you have your waiver form in place? What about your plan documents? Does it have your definition of eligibility? That the employee, to be considered full-time, had to work 30 hours a week? Do you have the measurement stability period? Have you made changes to that plan document or summary plan description? Do you have your summary and material modification? identified as an SMM. Then proof of affordability. Remember, for coverage to be affordable for 2015, it could not exceed more than 9.56% of the employee's income. Now, we know that we had some safe harbors that the Department of Labor gave us. And those safe harbors were, instead of the employee's household income, we could just look at the employee's W-2, their rate of pay for the federal poverty level. Did we make sure that we met those requirements? Do we have documentation showing what safe harbor that we used as an employer? The payroll records. The IRS may come back to you and say, let me see the payroll records so I can see what you deducted from the employee's pay, and it should tie into that. Proof of minimum value. We know that the Department of Health and Human Services has a minimum value calculator out there that you can use. You input your plan information, and it will tell you whether your plan offers minimum value or not. If you don't use the calculator, do you have actuarial certification of minimum value being offered by your plan? So again, those are some of the tips that you may want to go ahead and consider before you respond. You make that response to your letter 226J if you receive one. And with that being said, we're going to go ahead and open the line up to any questions that you have to see if anything has been sent over. Okay, while we're waiting to see if any questions come in, because right now we don't have anything in the queue, I want to remind you that we do have a scheduled webinar for Thursday, December 14th. It will also be at 10 a.m. And the topic is going to be avoid the pitfalls of plan administration. As a reminder, that webinar will also be eligible for 1 human resource certification credit. So if you have any friends who need those credits, make sure they sign up. It's an easy way to get a free credit. So again, not seeing any questions come in. Again, as a reminder, we will be sending to you a copy of the PowerPoint, a copy of the recording. Since there aren't any questions, we won't send a Q&A. It never be sent out to you via email. Also, if you do need the HRCI certification credits, let us know so we can send out your certificate to you. And since there aren't any questions in the queue, we're going to go ahead and thank you again. And if you would like more information on our brokerage, consulting, and compliance services, please contact our 1-800 number or email us at info@jrgadvisors.net. So I hope you found this information informative. It is pretty cutting edge. Again, it hasn't even been out for a month yet. If you need assistance with that, we do offer compliance services that we can answer questions for you. So please contact us if you have the need for the services. So thanks for attending, and hopefully you'll attend on December 14th. Have a good day, everyone.